I'm joined now by Alan Wilde. He is Head of Fixed Income and Foreign Exchange at Bearing Asset Management. I'm going to start with the big picture questions, which is the future of the eurozone itself. We've been seeing today how difficult Prime Minister Zapatero is finding it to push through those budget cuts. If the southern European countries can't cut their deficits, will they remain in Europe? Where do you see the future?
I think that's a very good question, Andrea, and I think the problem at the moment is that the central banks have tackled the immediate liquidity problems in the eurozone, but they haven't, and they can't really address the solvency issues. So I think the doubts will remain that over a 2 to 3 year horizon, the countries will not be able to push through with consistent fiscal measures to counteract the downturn and to address their budget deficits in a way which is acceptable to the general populace, and that is the big issue for southern European countries at the moment.
Now, you've changed your opinion because a few months ago you didn't think that, you thought that Greece and Spain would remain in the euro. Now you think they won't? Yes.
Well, the way we think about things was largely because the European project was obviously such a big issue for the German and French policymakers that we felt that the whole thing would probably hold together with sticking tape.
What changed your mind?
I think the recognition that the scale of the fiscal problem is so great that the measures that are required to restore competitiveness to Greece and Portugal and Spain are probably going to be too tough in the longer term. But let me be clear that we haven't yet concluded that that's a definite outcome. We just think that's a possibility, and a larger possibility than it was, say, 6 months ago.
And the idea that there is no mechanism for a country to leave the euro, you don't see that as an insurmountable stumbling block?
It's a big issue, and nobody really knows what will happen. In our modelling, what we assume is that you end up with a harder euro currency unit because the members that are finding it hard on competitive grounds or because of fiscal deficits to refinance themselves end up leaving, and you end up with a hard currency unit, which is, I guess, how the original euro was conceived, and that probably will restore some value to the euro currency, but we may have to go through another maelstrom in the meantime.
Now, what about interbank lending rates? How concerned are you about the Libor? I mean, there's been talk that it looks quite similar to the way it did in 2008. Do you think that's overblown?
I think it is overblown short term. There clearly is distress, and Libor rates are reflecting that. The basis spread between the euro and the dollar has obviously widened. The borrowing at the central bank has gone up, so it would appear as if the banks within Europe are less willing to lend to each other, let alone to obtain finance from outside the eurozone. So these are areas of distress, but we're starting from a much lower base, so I don't think we're going to return to the sort of very high levels of Libor, which were very punitive to the financial markets a couple of years ago.
And the euro is clawing back a little bit of ground today, but longer term, how do you see it?
Well, as I said, if we're correct in our assessment that there's a higher risk that the southern European countries, for want of a better description, will eventually leave the eurozone, then I think you will see the euro eventually bounce. In the short term, it's not inconceivable that the euro could fall further, but investor positioning is very short, and I think as the risk sentiment begins to improve over the next few days, you might well see a bit of a recovery in the euro in the very short term.
Right, so would you buy the currency at this level?
Probably for a trade, yes.
And what about bonds? Because I mean, if you really think that Greece is going to leave the euro, are you holding Greek bonds?
We've got some exposure, but very modest. Largely, we stayed with bunds, and we've been very happy to be in the high-quality end of the spectrum. But I must say that since the markets have moved aggressively through this crisis, bunds to me don't offer very great value at current levels. So, if anything, we'd probably be thinking about moving out of the quality trade in both bunds and treasuries and back into markets which have underperformed, but not necessarily those in the European zone.
I was going to say, so the underperforming markets are where? Presumably not southern Europe.
Well, no, outside the European area, I think that would be correct. Defensive markets for us would probably still be gilts to some extent. I think the gilt market's not fully priced in the fiscal retrenchment that we're going to get here. Canada still offers attractive proposition. Yields have stayed in check with treasuries, but it's a surplus country, both on a deficit perspective, a fiscal perspective, and on a current account perspective. So, you're relatively safe in Canadian bonds.
Indeed. Alan, thank you very much indeed for sharing all that with us.